There's one economic indicator that's preceded every single recession since 1969. 8 recessions, 8 correct advance warnings. It's the most reliable recession signal we have. It's called the inverted yield curve. Most people have never heard of it, but the Federal Reserve watches it closely. Wall Street watches it closely. Because historically, when this indicator triggers, a recession follows within 12 to 18 months. It triggered again in late 2025. And in this video, I'm going to show you exactly what it is, why it works, and what it means that it's flashing red right now. Value proposition. By the end of this video, you'll understand what the yield curve is in simple terms, why inverting it signals recessions, and what the historical timeline suggests for 2026. Let's break it down. What is the yield curve? First, let me explain what the yield curve is in the simplest possible terms. When you lend money to the government by buying treasury bonds, the government pays you interest. The interest rate depends on how long you're willing to lend them the money. Normally, if you lend money for a longer time, you get paid more interest. That makes sense, right? More risk, more reward. So normally, a 10-year treasury bond pays you more interest than a 2-year treasury bond. When you plot this on a chart, short-term rates on one side, long-term rates on the other, you get an upward sloping line. That's called a normal yield curve. But sometimes something unusual happens. Short-term rates go higher than long-term rates. The curve inverts. It slopes downward instead of upward. And historically, when that happens, a recession has followed. Let me show you why. Why inversion signals? Recessions. An inverted yield curve happens when short-term interest rates are higher than long-term interest rates. And there's a specific reason this matters. It reflects what the bond market expects about the economy. Here's the logic. When investors think the economy is going to slow down, they expect the Federal Reserve to eventually cut interest rates to stimulate growth. So they buy long-term bonds now to lock in today's rates before rates fall. That buying pushes long-term bond prices up, which pushes long-term interest rates down. Meanwhile, the Federal Reserve is raising short-term rates right now to fight inflation. So you get high short-term rates and low long-term rates. The curve inverts. And this inversion tells you something important. The bond market, which tends to be forward-looking, expects economic weakness ahead. And historically, the bond market has been right. The historical track record. Let me show you the track record. Ahead of each U.S. recession since 1969, the yield curve inverted first. The 1969-1970 recession, preceded by inversion. The 1973-1975 recession, preceded by inversion. The 1980 recession, preceded by inversion. The 1981-1982 recession, preceded by inversion. The 1990-1991 recession, preceded by inversion. The 2001 recession, preceded by inversion. The 2008-2009 financial crisis, preceded by inversion. The 2020 recession, preceded by inversion. 8 recessions, 8 advance warnings from the yield curve. The lead time has varied, sometimes 6 months, sometimes 24 months. Most commonly, it's been 12 to 18 months from inversion to recession. It's the most reliable recession warning signal we have, where we are now. Now here's why this matters for 2026. The yield curve inverted in mid-2023. It stayed inverted through most of 2024, and it inverted again in late 2025. Based on the historical pattern of 12 to 18 months from inversion to recession, we're in the risk window now. If the pattern holds, and it has held since 1969, we're looking at recession risk between early 2026 and mid-2026. Now, you might be thinking, the economy seems fine, unemployment is low, the stock market is near all-time highs. How can a recession be coming? And that's exactly what people said in 2006 before the 2008 crisis, and in 2000 before the 2001 recession, and in 1989 before the 1990 recession. The yield curve inverts before the recession becomes obvious in the data. That's why it's valuable. It's a leading indicator, not a lagging one. By the time unemployment rises and GDP falls, the recession is already here. The yield curve tells you in advance, and right now it's signaling elevated recession risk. What this means, so what does this mean for you? If the inverted yield curve follows its historical pattern, we're looking at recession risk in 2026. That means corporate earnings could fall, unemployment could rise, the stock market could decline, economic growth could slow or turn negative. The inverted yield curve doesn't tell you how severe the recession will be. The 2001 recession was mild, the 2008 recession was devastating. But it does signal that recession risk is elevated. And if you're invested in stocks, if you're planning major financial decisions, if you're managing a business, you need to factor this into your planning. This is the most reliable recession predictor we have. The track record speaks for itself. Disclaimer. This is educational analysis of economic indicators and historical patterns, not financial advice. Call to action. The inverted yield curve has preceded every U.S. recession since 1969. 8 advance warnings, 8 recessions. It inverted in late 2025. Based on the historical timeline, recession risk is elevated for the next 6 to 12 months. If you want updates on recession indicators and economic data, subscribe. Do you think the streak continues in 2026? Yes or no? Thanks for watching. Check out the video on screen about the 1929 pattern, another historical indicator showing warning signs. I'll see you in the next one.